In today's video, I'm going to go over what I think is a better strategy for entering trades, and this applies to any market. And I've said this before: the time to buy is when you're scared, when everybody else is panicking and they want to give away their shares, for any price. Then your job should be to take those shares from them. On the other hand, at tops, when the crowd just can't get enough, they're willing to pay any price for the asset. When traders are complacent, that's when you should sell. So when the crowd wants the shares badly, you should give your shares to them. So let me show you what happens at these cycle turning points, and why most people, I think, probably use an inferior strategy to enter and exit the market. So I'm going to look at these intermediate cycle lows, and I've just got the mining stocks on here as an example. So by the time we get to one of these intermediate cycle bottoms, we'll see intermediate degree sentiment is extremely bearish. That means that 90% of the people have become shell-shocked. Usually the correction has gone much deeper than they originally anticipated. To start with, they think it's just going to be a pullback, and they buy too early, and then the market continues down. At some point they get stopped out. They may do this twice. By the time they get stopped out twice, now they're afraid to pull the trigger again. They don't want to make another losing trade. So by the time we get to one of these intermediate bottoms, 90% of people are scared. They're selling in a panic, and buying is usually the last thing that the herd is thinking about at that point. At one of these intermediate bottoms, price usually has gone down low enough to where 90% of traders are now convinced that the price is just going to keep going down. And we've seen this time after time over the years. You'll hear traders say, well, price looks like it's going lower. Well, of course, at every intermediate bottom, price is always going to look like it's going lower. And this is usually the time that I'm telling people to buy. And the technical traders are looking at the charts, and they're telling me that price is going lower. Well, price looks like it's going lower on the chart, but the cycle durations and the sentiment are telling me it's time for a turn. So that's the point at which I don't care what the charts say anymore. I'm more concerned with what the cycle duration is and what the sentiment levels are, and maybe the COT reports as well. So here's what most people will say. We get a bottom. Very often on a swing, I'll make a call, even here on the public blog sometimes, that I think we've got a bottom and you can start buying. And most people just can't pull the trigger. They're too shell-shocked. The charts say the price is going lower, so here's a classic phrase: I'm going to wait for confirmation. Now, confirmation can mean a lot of things. It can mean, price moves above a certain moving average, moves above a resistance zone, etc., etc. But generally, by the time the vast majority of traders get the confirmation they're looking for, then price is going to be overbought. So first off, you got traders that are scared because of the intermediate decline, and then let's just take this bottom as an example. So we've got our swing right here. This would be day one. This would be where you would want to buy. Your risk is very low. Your stop would be right here, so your stop is very close to your buy-in zone. And then most people, of course, won't be able to buy here because they're worried that it's going to turn out and go lower. And then the next day we get what looks like an exhaustion candle, which confirms, the feeling that of most traders that this was too early, and it was a good thing I didn't buy. And then the next day you get a down day, which is more confirmation that yes, the correct move was not to buy. This is going lower. And then the next day, we jump up, but again, we've got what looks like an exhaustion candle. So the nervous traders stay on the sidelines. The next day after that, another reversal candle. Nothing yet to, soothe traders' emotions and make them feel comfortable about buying. Next day after that, another exhaustion candle. So by the time they're ready to buy, we are overbought, and so they've already watched a pretty decent move go by here. I think this is about 5 or 6%. So they've already watched about 5 or 6% pass them by, and now they're looking here and they see that the market's overbought, and they can't bring themselves to buy into the overbought conditions. I mean, they've already gotten stopped out once or twice by buying too early on the way down. They're nervous. They don't want to take another loss. So they've got confirmation, so to speak, but they've also got overbought levels, and they just don't want to chase into overbought levels. So what you hear is, well, I'm going to wait for a pullback. So at some point we will get a down day, and you'll get a pullback. But the problem is that the memory of the previous intermediate decline is still fresh, and so usually the first pullback at that point, it doesn't really look like a pullback. It looks like it could be the start of another leg down. So usually the traders that have waited for confirmation and then couldn't buy because of the overbought conditions, then they get the pullback, which they said they were waiting for, but their emotions now become confused, and they're not really sure that they want to buy the pullback. So usually they'll miss this opportunity. What they want is they want to time a perfect entry. So they want to wait for a pullback, and they want to time it perfect. But when it comes, without a crystal ball, you don't know whether the pullback is going to last 1 day, 2 days, or 3 days. So after 1 day, you're nervous. You want to time the perfect entry, but you don't know whether the pullback is only going to last 1 day or 3 days. So you sit on your hands. You can't pull the trigger. And then what generally happens is during the advancing phase of an intermediate cycle, price can stay overbought for long periods of time. You can see here and here. So then you get one of these things where the price just runs away from you, and this is the point where traders usually at this point they're just about panicked. They've watched 7, 8, 9% go by, and now they're convinced that the move is for real. So now they're ready to get in, and of course, by the time your emotions give you the all clear, it's the same time everybody else's emotions give them the all clear. We're all looking at the same charts, and that, of course, means that sentiment has gotten too bullish short term, and we're going to run out of buyers temporarily, and then you get a pullback, and this is usually occurs at a half cycle low. And so the people that finally bought right here, then of course they get stopped out as we move down into a half cycle low or a daily cycle low, and now they're nervous again, and so the process repeats. And usually, it'll be somewhere maybe up here before they can actually buy with the confidence to hold their position. And then you can see what happens. There's just not many days left in the intermediate cycle. And then at some point we turn and we start to go back down, and then they get stopped out for a loss. And so they let this whole intermediate rally go by because they were too nervous, couldn't pull the trigger at the bottom, had a poor entry strategy, waiting for their emotions to give them the all clear to buy, and then just end up buying at a short-term top and end up taking a drawdown, and very often stopping out of a drawdown when their whole purpose of waiting for confirmation was so they wouldn't have to take a drawdown. And in reality, what it usually does is it pretty much guarantees taking a drawdown. So now let's go on to where we're at right now. So the other day I mentioned that we had our swing, and it was late in the daily cycle. The odds were pretty good that we've got a daily cycle low, and because this is also late in the intermediate cycle, this is the odds are very high that this is also an intermediate cycle low. Obviously, most people miss this rally, and here we're in play. So the first thought is after you've had to weather a 3-month drawdown here as this goes down, well, you're very suspicious of any move. So this rally on the FOMC meeting, even though I warned traders for months that this was very likely going to mark the bottom, still most traders are just nervous. They're just not ready to believe that this is going to be the beginning of a new rally yet. And the next 2 days gave them confirmation. There was no follow through, so there's just no reason to pull the trigger. And then today we've got a little confirmation here, a bit of a move. At least we've gone above the Wednesday's high, but now we're getting ready to get overbought. So I'm seeing the calls, the stuff that we see at every one of these. I'm not going to chase. I'm going to wait for a pullback. Well, you had a 3-month pullback and you didn't buy here. What makes you think you're going to buy anywhere else? I guarantee you people didn't buy here. They didn't buy here. If we get a pullback in the next few days, people are not going to buy. It's going to look like that this is rolling over, and then we're going to have another leg down. So people can say they're going to buy, but they just aren't. And so this is the thought process that 90% of traders go through, and it's what makes them miss most or all of these intermediate rallies, or they just end up buying too late in the rally, and there's just not much upside left yet at that point, and then they end up, once the market rolls over and starts down, they end up having to sell for a loss, and they just end up not making anything. So I'm going to suggest again that you need different tools to call these bottoms rather than charts. The charts are always going to look like they're going down at these intermediate bottoms. A chart is not going to be your friend at an intermediate cycle bottom. What you need is a working knowledge of cycles analysis, and you need a subscription to Sentiment Trader so you can monitor real-time sentiment. And if the cycles and the sentiment and the COT line up together, well, you have to pull the trigger at these bottoms. When you get a swing, you have to pull the trigger, and you have to quit worrying about a drawdown. And in this case, if you're 47 days into the cycle, like I explained in my last video, then don't worry about a lower low. The cycle is running out of time, so a lower low, while it may be scary for a few days, it's not going to generate a sustained move down at that point, simply because you're just running out of time in the cycle. So you can hold through a marginal undercut at that point if you're late in the cycle, because the cycle bottom is coming, and then you're going to turn and you're going to head back up. So a much better strategy, I think, for getting in and actually making some money off of these intermediate cycle lows. You want to buy close to the bottom when you're scared, when your stop is close, rather than waiting for confirmation when your emotions give you the all clear. uh, and where you're liable to incur an immediate drawdown, and where your stop is a long ways away. Your correct stop is always below a daily cycle low. Anything other than that, and you run the risk of getting needlessly stopped out of a winning trade.